Today, yield curve, recession, and the housing market. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today I have Tarric Brooker with me for another Friday afternoon chat. Hi Tarric.
G'day Martin, how are you?
I'm all right. How are you going on?
Yeah, not too bad, mate. There's certainly a lot to talk about, but there always is.
Well, yeah, that's right. And somewhere along the line, we should just touch on the deceit in the budget, because I think that is worthy of quite an exploration, right? How come everybody thinks that he's giving lots of money away when in fact next year he's going to take it away?
Well, it's an interesting one, isn't it? We're all going to, there's going to be the tax offsets to the tune of $420 this financial year, but then the $1,080 worth of tax offsets are going away next year. So it's all a bit of a bait and switch, but that's not really any different than what we've come to expect.
Well, I guess that, and of course, then the excise will be reversed. So at some point in September, so that's another cliff. Plus, of course, cost of living continue to rise, and interest rates probably going up too. So I have to say that a lot of the coverage really didn't get to the heart of what was going on.
Well, I just think it's interesting that the government has taken the same route as basically most other governments in the world, in the sense that despite the fact that the economy is strong in headline terms, in terms of low unemployment, in terms of headline GDP growth, they've decided to solve an inflation problem by printing more money. And it doesn't take a rocket scientist to know that what's potentially going to happen as a result.
No, that's right. And of course, it's the other worth just remembering that the old RBA has been happily buying state bonds and government bonds, so they've been creating this money from nowhere, literally, right? You just issue on one hand, then they buy them so they can set the price. Now, of course, if they stop doing that, then the costs of funds for states and for corporations and everybody else, including the government, is going to go up. And it's interesting, in the budget, they were forecasting that the costs of funds will be rising. Big debt, of course. So something doesn't quite fit.
No, it doesn't. And that's something that Alex Joyner made an interesting point about on Twitter earlier today. He's an economist from IFM, for those of you who may not be aware of him. And he was saying that he in his view, and which is, sort of based on, his perceptions of the industry and contacts, etc., that bank interest margins may expand, not contract, on the impact of rise as rates rise, which means that rates are not only going to potentially rise if the market is correct and rise significantly, but they're going to rise by more than that because of things like the TFF coming off and the banks having to go and find funding from the market and not just cheap money from the RBA.
That's right. And I don't think that people have thought through the implications of that. For example, today, ANZ and NAB put their fixed rates up again. And they've now put the rates up on their nearer term fixed rate mortgages. But of course, everybody is still pushing those very cheap, low variable rate loans, right? But of course, as soon as you lock yourself into a variable rate loan, then you're on the escalator when rates rise.
Well, that's really the problem with the RBA and with the government strategy, with what they've done in terms of the TFF, and even what they've done in terms of Home Builder and these other programs. They've stimulated demand in the short term, which is obviously been beneficial to homeowners, people who benefit from rising housing prices, and the construction sector to a degree, although now that's looking like more than a little bit of a double-edged sword. But the problem is that you create this scenario down the road whereby all those positive those positive tailwinds come to an end, and then obviously things flip the other way. All of a sudden, that support is not there. And, like say, as you said, with the TFF, at some point, probably around about, late this year or early next year, the banks are going to want to get a head start on replacing those funds, because they're not going to want to all go to the market for $188 billion for a banking system the size of Australia's all at once, because obviously that would put upward pressure on funding costs. So, those headwinds are certainly there for both the economy and the housing market in that regard.
And of course, when you think that quite a lot of the bank debt is funded overseas, particularly in the US markets, where of course rates are now looking like they're going to go up too, the international rates will be higher. So every way you look at it, the only way is up.
Well, as things stand, absolutely. And I think that's something that's really interesting in terms of, like, say, for example, the US rates, because here in Australia, we've got, oh, no, that can't happen, that can't happen. But in the US, in relative terms, they are currently undergoing the largest rate hike cycle, because their rates are done via the bond market. The largest rate hike cycle since, at the very least, since the 1980s. And, with rates in relative terms rising by over 76%.
It's frightening, isn't it? Well, I think that's a good way into your charts, because I suspect we're going to be touching yield curves and all sorts of exciting things today.
Well, there's actually no room for yield curves today, believe it or not, but there's a lot about housing, and I know that's what a lot of people come here to see.
Jolly good. Well, let's go for it then.
Okay, well, we've got another little cartoon here from investing.com today. And if you would like to look at these charts, I'll be no doubt posting a link up on Twitter, but there you can also get them at avidcom.substack.com. And if you'd like to subscribe, that would really help me out. It's completely free. So yeah, have at it if you would like to. My apologies. There we go. Okay, now, as I mentioned, this is a chart I put together based off the data from Freddie Mac, which is one of the US, well, effectively a mortgage provider, or that they sort of backstop the system in that regard, and it shows that all the various hiking cycles in terms of the rises in the 30-year mortgage since 1980. And as you can see, the latest rise has been by far the largest. And it's also arguably not over. But I think one of the things that's really interesting is you hear about, say, for example, The Big Short, about how rising rates played a role in popping the US housing bubble, yet in relative terms, the rising rates during that period between 2003 and 2006 is less than half of what's been experienced so far in this hiking cycle.
So let me just be clear. This is what's already happened? Or
yes.
Yes. Okay.
This is what's already happened.
So this isn't market expectations. This is the current movements already, and it's already bigger than ever before.
Not ever before. I'm not sure. I need to go through, and I need to do the ones for the 1970s, for the late 1970s. But in terms of basically the start of the Reagan administration onwards, actually it's even the tail end of the Carter administration, that this is what's actually happened. And I think that that's just really interesting, because in the US, currently housing prices are touching around about high six times, low 7 times household income, depending on what median income you're talking about and which housing price provider you go to. But that's really interesting that they're ringing alarm bells about a housing crash now, because rates are rising, because prices have risen so quickly. Yet, if housing prices in, say, Sydney fell by half, they'd be roughly in the same ballpark as where US housing prices are now.
Yeah, and it's just worth remembering, of course, in the US, the mortgage rate almost always is a fixed long-term rate. So in other words, consumers are protected if they've taken out a rate at the very low rates previously for quite some period of time. In Australia, of course, it's not the same. We've got a higher proportion of people on variable rates. So if real rates gets translated as you might expect, they will be hit immediately.
And that's an important thing to keep in mind as well, about when thinking about the RBA versus the Fed. Now, in the US, around about sort of 70 odd percent of household debt is mortgage debt, right? Of which about, at the latest data I have, which is about 2018, I believe it's probably higher now, but at that point, about 90% of mortgages were on fixed terms of between 15 to 30 years. So those people don't really need to worry about rising rates. But it also means that the Fed needs to raise rates higher than other central banks around the world in nations that do have variable rates, because them raising rates has no impact on existing borrowers in the way it would in Australia or elsewhere. So that could create a really interesting rate differential between the RBA and the Fed, and just, well, everyone else in the Fed in that regard, because they need to raise rates higher to impact aggregate demand, which is how interest rates and inflation functions.
And of course, they're already forecasting considerably higher rates over the next year or two in the US. Most market participants are saying there will be some rate rises of 50 basis points per meeting, and there are 5 or 6 meetings or whatever the number is now, which means that we could easily looking at 2 or 3% higher.
Well, some folks, I believe it was Citi, came out the other day, and they said that they see a federal funds rate, which is the US version of our own RBA cash rate, at 2.75% by the end of the year. Now, that's just, as you might imagine, that's a rather sort of wacky thing, because, can you imagine what Australia or any other country in the world would look like if that were to occur? And there will be a chart for that later on.
Whoopee.
Okay, now this is from IFM today, and it shows what's going on in the housing finance figures from the Australian Bureau of Statistics. And there was a shock fall. Market expectations were for a 1.5% rise, but instead it's fallen significantly by 3.7% overall, with owner occupiers leading it down, dropping by 4.7% for the month. And the real big story in that regard is the impact on first home buyers. First home buyers are slowly becoming a bit of an endangered species relative to where they were before, with the number of first home buyers for the month down 9.7%, and for the year down 29%.
Yeah, investors quite hot, but actually even investors lending was down a bit too.
Yeah, it's really quite interesting. And one thing that I thought was quite fascinating was looking at the internals of the data, was that the average loan size for New South Wales fell. Now, considering that the first home buyers falling away are mostly occurring, they are obviously mostly occurring because Sydney and Melbourne put together are absolutely enormous, but they're obviously occurring largely in the most expensive markets where first home buyers have been priced out, not entirely, but to a significant degree. Yet, despite the fact that you've got first home buyers dropping away, and obviously their loan sizes are generally smaller, the average loan size fell in New South Wales rather significantly, which I thought was a rather interesting little data point, considering that this all predates, the sort of really, really sort of challenging environment that we've seen since the Russian invasion of Ukraine, since the increased tempo of rates are going to rise, etc. in the media.
Well, I think there's a couple of factors. The first is that, of course, the move from 2.5% to 3% buffer has now worked its way through. Remember, that was implemented earlier in the year, but the application process takes a bit of time to come through. Secondly, of course, the loans are a lot bigger in New South Wales, and so therefore the underwriting standards actually tend to provide more of a barrier for bigger lending. And then the third is that some people are getting a bit cold feet about mortgaging themselves up the hill given the prospect of higher interest rates. I see that in my survey. So, but it is interesting, and it's rather interesting to see the reversal of that very strong trend in terms of growth in the average loan size. And New South Wales is leading the way. Biggest market, could have an impact.
Well, I think one of the things that's interesting about the housing market more broadly is that, say for example, Lindsay David, I think explains this beautifully on Twitter and in some of his writings, that in order for housing prices to continue to grow infinitum, housing credit needs to continue to grow. It can't stagnate over a long period without prices starting to fall because of inflation and everything else. But it's rather interesting in that regard, because it doesn't take housing credit reversing. It just needs to just slow down significantly over a long period of time to a crawl or to basically zero. So I think that's going to be something interesting to watch, because in my view, I think what we're going to see is a bifurcation of the markets here in Australia. With Melbourne and Sydney. I mean, as CoreLogic came out yesterday and said housing prices are already falling there, but they're rising elsewhere. So I think that borrowers may have hit a bit of a limit in Sydney and Melbourne, but elsewhere, the party may go on for a while longer. But we just have to see what happens with rate hikes.
Well, Brizzy is still way ahead. I mean, it's close to 30%. Right, massive. That's partly the interstate migration and also the fact that properties are cheaper. But if you look at Hobart and if you look at Adelaide, they're still relatively positive. So I agree, bifurcation is likely. Or is it a timing question? would we actually expect to see the Sydney and Melbourne markets cool first, and then that sort of spreads out? Because in the last two downturns, that's precisely what happened.
Well, it's entirely possible, and I mean, it's one of those things, right, where I would just say that I'm smart enough to know that I don't know.
Oh, you're the one.
Well, it's just one of those things, because there's a lot of different factors, as you say. There's interstate migration. There's the fact that there's the exodus from Sydney and Melbourne. I mean, like I did a calculation the other day that that Orange is pushing is something around about like 8 times household income now.
Yes.
Which is just and that's based on some fairly shall we say, generous assumptions on wage growth since the last census, and that's just the way it is, I guess.
Same down here in the Illawarra, where in fact the multiples have gone through the roof, literally, and that's again triggered by people moving out of Sydney with bigger incomes and being able to buy down here, and displacing the locals who now can't afford to buy in the local area. So they're having to look further the other side of Wollongong and down where in fact prices are still a little less aggressive. This has big social consequences, actually.
Yeah, it really does. And without me going off on another one of my famous rants about how broken this all is, I should probably move on to the next slide. Okay, now this just shows what the ABS finance statistics were showing, that first home buyers are falling away. There's the grants are ending. We're seeing, when that's arguably partially why both the government and Labor are moving to further fire up the yield first home buyer supports. With our tax dollars on the line.
And we are so generous. We tax people, we taxpayers, very willing to help more first-time buyers into the market by giving them an on-ramp to help prices go even higher, so that the next cadre that come on have to pay even more.
Yeah, well, I mean, eventually we're going to see, buyers just get exhausted. I mean, I think that, but once again, that could support the bifurcation theory of the market, because there are people in, say, for example, Brisbane or Adelaide or Perth or elsewhere who can, with a 5% deposit, still get into the market. But in, say, for example, Sydney or Melbourne, if you're on anything approaching a median household income and you're wanting to buy anything approaching the median home, it's quite a bit more challenging in that regard, particularly if you only have a 5% deposit.
And of course, there are some limits on how much how high it goes and those sorts of things as well. And Labor did the same. So it's sort of targeting in a particular segment of the market in terms of how much you can afford, and a lot of it will be apartments, which may align with the surplus of apartments that are currently almost everywhere you look. I'm
shocked. I'm so shocked. I mean, especially after hearing you and Edwin been talking about that for a long while now.
Yep.
In your Monday property rants.
Yes. Yep.
Okay, this chart's from CBA, and it shows basically what's going to happen in terms of mortgage repayments as a percentage of disposable income. Now, the chief economist of CBA came out the other day and said that if the cash rate were to go to 2.5%, it would send mortgage repayments as a percentage of disposable income to its highest level ever. And forever is a long time. And it's rather interesting that despite the fact that we've seen interest rates at 17%, as some viewers will be aware of, the fact that 2.5% is going to take the repayment burden to its highest level ever is rather interesting, particularly considering that the market is now pricing a cash rate north of 3% in just 18 months' time.
Yeah, and the other point there is that the loan is a lot bigger, of course, relative to where it was previously, and the term is a lot longer. If you go back, when rates were 18%, the average mortgage was 20 or 25 years, right? More and more people now are getting 30-year plus mortgages. So in other words, they're paying a lot more interest over a longer period of time. But it also means that if interest rates go up, then the cost of that interest rate rise is even more aggressive. And, I may have said before, if you go from 1.99 to 3% over a 30-year term, that's equivalent to a 15% increase in a monthly repayment. If you go from 1.99 to 4%, that's 30% higher.
Yeah, exactly. And we're talking about over a 3% rise of where we are now, which is just...
Exactly. The other one, of course, this is an average, right? And this will include people who actually had mortgages for a lot longer and are well down the path of repayment. So the other way, as I always say, averages mask, and actually averages mask here dramatically so, because there are a lot of people who are very comfortably off and don't have a big amount to deal with. Therefore, the total outstanding is low. Therefore, the interest payment doesn't have a huge impact because the quantum of the payment is not great. But there are a lot of people who've borrowed over the last couple of years. Look at the first-time buyers from that earlier chart. They're the ones really exposed. Not only is it a big movement up, but it's a big mortgage relative to income to start with. So this is going to be quite painful.
Indeed. Now, we've all seen, well, many of you have seen the chart that the RBA cash rate futures have, whereby you see what the RBA cash rate is going to be on an 18-month window. Now, what I've done here is I've taken that chart and extrapolated it and added it to the average payable variable rate as reported by the RBA. And this shows where the market believes rates are going to be over the next 18 months. So believe it or not, if the market is correct, we're going to be looking at mortgage rates of very nearly 6% on an average basis. And that's provided we don't see further increases, so the banks can afford to pay for higher funding costs as the TFF ends.
Yeah, and just to be clear, right, we're talking August next year. So in other words, 1 year, 4 months away on that chart.
Yeah. And it's important, this is just market pricing. This is not set in stone or anything like that. This is just what the market believes will happen.
Yeah, and the market is also aggressive in the US. And you know, the RBA will drag the chain as long as possible. But there is going to be a horrible contention between the RBA knowing that if it puts rates up, it's going to crash the economy and put a lot of people, into pain, versus the market pressures which are driven off the yield curve and the international finances that we spoke about before. The interesting question is who actually ultimately can win. Of course, the RBA sort of won for a little while, but then he got beaten effectively, had to withdraw its yield curve control. And I have this theory that the only thing they could do is do another term funding facility where they would actually provide really cheap money to the banks again, which would then put the problem down the road a bit, but it won't solve the problem.
No, I mean, that does seem like the modus operandi at this point, because as you say, if these cheap, when these cheap funding ends, it's going to be a significant problem even based on rates where they sit today. So you're talking about that being a problem in probably under a year at this rate when they do start to refinance those funding. But it's just going to be fascinating to watch, because the RBA know how much trouble they're in. They know what an issue this is going to be. Although I will say, from a purely just Machiavellian perspective on this, if rates do rise by 3% and then the housing market blows up, they can say, see, the buffers did work, but we just weren't able to cope with such large rate rises. And that politically gets them off the hook, ironically.
Yeah, once again. And of course, Michelle Bullock was announced today as the new deputy to replace Guy Bell, who left. So she'll be sitting there in the Senate explaining it all.
Well, I don't envy her in that regard, although I think that, as I was saying on Twitter a couple of days ago, I think that there is a universe in which the RBA sits on its hands for a lot longer than many of us would like, and a lot longer than the market expects, because the dollar is stronger because of commodity prices, and they do arguably have scope to sit on their hands in that regard, because as we discussed a few shows ago, if they're claiming that their main focus is wages, and the government's budget papers have shown we're going to see this massive ramp up in immigration, maybe they were going to be able to sit on their hands because their targets haven't been met.
Yeah, well, they've sort of given themselves a little bit of an out, haven't they, because of that, as we discussed the other day. And it comes back to this contention between what the market is thinking versus what the RBA might be thinking. I'm with you. I don't think that these rates are going to rise as quickly as people from the market perspective, are saying it's probably maybe 1% or something over the next year or so. But even 1% is bad enough for many people.
Well, that's what's going to be interesting because, as I was saying, the Fed does have the scope to do that, and if the market is anywhere near correct, it will do that. So it is going to be interesting in that regard to see how long the RBA can sit on their hands. I mean, it might be a lot longer than we think.
Yep, certainly could well be. And of course, the APRA guys will be able to say, well, from a financial stability perspective, there's nothing to see here, and just carry on with their looking the other way and not seeing any problems.
Okay, this chart I quite like. It basically shows that US goods spending in inflation adjusted terms actually peaked in about March, April last year, because that was when the last stimulus checks from the Biden administration went out. And since then, it has trended sideways and frankly a bit down. But the thing that has been driving the US economy has been consumer spending on services returning to trend. Now, this to me, and as you can see even towards the end of 2021 there, that particular growth driver is really starting to run out of gas in that regard. And we saw that in the Q4 GDP figures, because once you took out inventories, it was actually a very, very weak figure.
Yeah, and there are some interesting leading indicators to suggest that the US economy isn't probably as strong as perhaps the Fed is wanting it to be.
Well, exactly. We've seen the inversion of the 10-2 yield curve, the 30-year, 5-year yield curve, and traditionally those have been indicators of recession. I believe it was Morgan Stanley who came out with the paper the other day saying that the time between the 10-2 yield curve inverting and recession was about 13 months. Now, one of the reasons I find that really fascinating is because up until relatively recently, Wall Street has been saying we are on an accelerated cycle. And to be completely fair to them, they've been absolutely correct. We've seen the economy go from bust to boom to full employment to runaway inflation in record time. Now, the question is that particular trend going to remain true in terms of the business cycle more broadly? Because we've boomed very quickly, but the question is it going to bust equally as quickly?
Now, I think that's a great question, and I've been reading a few different economists who have very diverse views about this. Some people saying it's different this time, so just because we had a yield curve inversion, there's so much stimulus and everything else going around, it's really not going to necessarily follow the recession follows. Others are saying, well, it'll be a recession, but it won't happen for several years because of this slow, period it takes. Others are saying, well, actually, we're in a very accelerated world now. Things are going to move much more quickly. There are so many downside risks all mingling together that if a recession starts, it's going to come in quite quickly and go quite deep, and it will be very difficult to control. I'm not sure anybody really knows.
No, and that's, like people have asked me recently about recession predictions and that sort of thing. And the truth is that there are so many different variables at this point. And I know some will see this as a bit of a cop-out, and perhaps it is, but the reality is there are so many different variables going on at the moment. There's the war in Ukraine, there's the sanctions, and then there's just the other issues that we've discussed previously. There's issues with social unrest, there's issues with food security. There's all these problems that could easily snowball into something really horrible relatively quickly if mismanaged. And it's very challenging to predict where it's going to go in that regard. And then as well, in addition to that, it's not easy, but it's easier to predict where things will go under more normal circumstances. But you've got governments behaving like morons and throwing more money at the economy, even when inflation isn't nearly 8%.
No, absolutely right. And I was reading one of the economists today saying, if the Fed had actually started what it should have done last year, the chances are they could have actually managed it with relatively small moves, but because they left it so late, the moves have to be a lot bigger to be able to have any impact, because the momentum of inflation has now picked up dramatically. And their view is that the Fed has been behind the 8 ball for a long, long time and remains so. So, yeah, it is hard to say. My own perspective, I think, would be inflation is going to probably be higher than people think, and it's going to go on for a lot longer. And I'm still bemused as to what extent lifting interest rates is going to fix supply chain driven inflation. That's the question that I haven't read a good explanation for yet.
Well, I mean, I think it will fix inflation in the regard that, say, for example, like US inventories have seen some of the biggest builds in history in percentage terms in recent months. We're seeing this massive rebuilding of US inventories. Now, the issues in China with COVID, with lockdown, etc., is obviously going to impact that. But I think it's going to be an interesting one to see unfold, because there are a lot of different factors pulling in different directions. Because on one hand, you have seen things improve, you have seen inventories improve. But then with the war in Ukraine starting to impact everything from semiconductor production through to simple things like wheat and corn and sunflower oil, you don't know how that's going to snowball. And it's in addition to that, it's also about the substitution effect as well, in the sense that, okay, I can't buy canola. Say, for example, the other day, Russia banned exports of sunflower oil. I believe that happened yesterday. Now, okay, fine. Sunflower oil prices are going to obviously rise based on that because of supply and demand, etc. But then there are going to be other oils, other alternatives that are then going to rise, that are then going to have knock-on effects into everything else. So it's those sorts of second and third order effects that make predicting how things are going to unfold that much more difficult in this highly uncertain environment.
Absolutely. And then Russia then comes out and says, well, I want to be paid for my gas in rubles rather than dollars, right? Now, that's another factor to throw into the mix just to add on everything else.
Well, exactly. I mean, you've got some analysts and advisors saying that it's akin to an act of war, that they're basically just going to cut them off. And, it could easily all go pear-shaped so very quickly in that regard. And, I mean, we could be in a recession tomorrow. It's that, it could be a year, it could be 2 years, it could be next week. It's just really challenging to predict in that regard, because, and not only that, but it's at times it's hard to see that some of our leaders are behaving all that rationally with the way they're conducting themselves in terms of fiscal policy and everything else.
Rational? Oh, no, political. Rational? Not necessarily the same.
Well, exactly. You've got the US, releasing 1 million barrels a day from the Strategic Petroleum Reserve, with the plan that they'll buy it back cheaper later. Now, okay, maybe that'll work, but it's a pretty big gamble, because if it doesn't, that means they're going to potentially have to rebuild their stocks, particularly if there are other geopolitical forces that threaten, to upset things even further. That they may have to rebuy all that oil at a significantly higher price, which is only going to put further upward pressure on oil down the road.
Absolutely. Well, I've committed to 180 days worth of those releases. So in 6 months' time, it'll be an interesting question as to where things stand then.
Absolutely. Now, I like this chart quite a lot, because it basically shows over the last 40-ish years the relationship between US wage growth and the US federal funds rate. And basically, it shows that there's a quite strong correlation between the two. And recently, US wages have rocketed to the highest level since the late 1980s. Now, if this is the chief concern of the Fed, avoiding a wage growth feedback loop is something that they're very, very concerned about. And if the likes of people like Jim Bianco, who's done quite a lot of good work on this, are correct, rates may have to rise significantly higher than even those what we would consider extremely high estimates, like cities that have 2.75% worth of rate hikes in 2022. Well, it may not be enough. It may actually, the federal funds rate may actually have to go significantly higher. Well, at least until they end up breaking something anyway.
Well, I think one of the interesting things about that chart is that up until 2010, there was a quite close correlation, but since then, you can see all those controls that have been put in place by the federal bank. So it's got a bit more disconnected. So the question is, how much longer can they keep that disconnection going?
Indeed, particularly, with wage prices, right, with wage pressures rising, I should say, that is going to potentially be a huge issue. And there are some analysts who've already concluded that we are basically already in conditions that could cause a wage spiral. because we're not talking about, my costs rose by 2% and I'm falling behind. Therefore I'm going to demand a wage rise. For a lot of people in that, they're seeing themselves fall behind by 4, 5, 6, 7%, especially people who haven't seen any pay rise at all. Eventually people get sick of not being able to be able to afford the basics, and they will demand higher wages. And it's all well and good for people to say, oh yeah, but if the economy slows down, they're just going to be happy to have a job. But we have to get there first, and I mean, as you probably know better than most people, there was plenty of wage price pressures in Britain in the 70s and the 1970s and early 1980s,
Yep.
even while industry was falling to bits.
Correct. Yeah. It was interesting that early in that cycle, people said, "Oh, it's only fragmented. It's going to settle down. It's transitory, right?" And then it started to actually go across into the wages domain, and wages demand and wages growth grew very strongly in the UK as the economy fell apart. And despite the economy falling apart, wages demand still rose. And there were various attempts to try and control it and try and reach some pact to try and actually keep it under control, which didn't work very well. And it was, 15, 20 years before they really worked out how to deal with it and pull it back down again. Now, if that sort of cycle happens again, in other words, if the wages part of inflation really takes off, as it could well be in the US, it's going to be really difficult to control, and it's going to be hard to see how they can fix it in any short-term cycle.
Well, the ironic thing is that the most efficient means of controlling inflation, at least on a short-term basis, because there are arguably structural issues, demographic issues, etc., that could cause inflation to go higher. The quickest way is just cratering the market. I know that that's a relatively unpopular thing for some people, but at the end of the day, if the Fed has a choice between, as you say, a potential protracted long-term cycle of wage spikes and of rising costs, that may be something that's unacceptable to them. That may be something that basically puts the Fed put, as they call it, for the market a hell of a lot lower than what a lot of people think it is.
Well, I think there's a really good question about the Fed put and where it is and at what point. I'll make another point, though. The only way to deal with the massive debt overhang that we've got globally is to allow inflation to deflate the value of the debt that's outstanding. So I wonder whether the Fed is further conflicted by the fact that, in fact, if inflation is a bit hot, it actually does reduce the size of the debt pie. And is that going to actually also play on their minds in terms of how far they pull what levers?
I think it comes down to politics, really. I mean, while obviously that is preferable for the Treasury in a vacuum, I think the reality of it, in terms of corporate earnings getting slaughtered by rising costs like they did in the 70s, is something that a lot of, shall we say, influential people are not going to want to see happen in that regard.
I think you're probably right. Exactly. Yeah, the path of least resistance is where the Fed will go. And as you say, it'll be driven predominantly by politics rather than by economics or anything else. And I was reading again somebody writing saying, don't be misled, both the Federal Reserve and the RBA is not isolated from the political landscape. They're very much part of it and actually right in the middle of it. So most of the decisions that have been taken and will be taken will be politically aligned rather than actually economically aligned.
Yeah, and that's a fascinating point, because in political terms, they're being pulled in two entirely separate directions. Because you've got the RBA, and obviously we've got our enormous housing bubble, which both sides of politics don't want blowing up on their watch. But on the other hand, you've got Powell and the Fed and inflation. And as far as Americans are concerned, inflation and the cost of living are issue number one and issue number two. And absolutely. I think about 2/3 of Americans call those that they're, at least according to a recent poll, the most important issues to them.
Absolutely. Yeah, fascinating times.
I like this one from Morgan Stanley because it basically shows that we're in conditions that are consistent with a potential inflationary spiral, and that feeds into what we were just talking about in terms of the wages growth issue. I would argue that, considering how rapidly wages growth has taken off in the US, that it's probably potentially even more severe than this chart illustrates.
Yeah, well, that's my sort of conclusion from looking at all of the data over the last few days. I think that the foundations are already laid for an inflationary spiral that's going to be very hard to control, which is why the Fed is going to have to put rates up, and almost despite the consequences. And whilst they can, to an extent, blame Russia and Ukraine and the international supply chain issues, you've got to come back to the underlying reason. Well, is it something to do with how much money was created in the last couple of years, and the very low interest rates? Could that have something to do with it too?
Oh, that would just be a shocking conclusion, wouldn't it? I mean, particularly that they're just going around throwing even more money at the problems that come up. Oh, petrol prices are too high. Here you have $400 a car, like they've got in California. No worries. I mean, I think it's interesting because in traditional economic terms, demand destruction is what inevitably addresses high prices. Yet, how can you have demand destruction, for example, for oil and petrol, when you just keep giving people money in order to pay the higher prices for the oil and petrol? It doesn't really make any logical sense unless you're looking at it from a political perspective.
No. Well, if you start from the assumption that nothing can fail anywhere and we'll just create more money from nowhere to be able to throw at it, to be able to keep the ball up in the air a bit longer. It's like playing those games at parties when you keep the balloon in the air, just keep patting it around and just, must never touch the floor. The question is, how long can that go on for? At some point, the quantum of debt that you've created becomes effectively unmanageable. And are we there? I'm not sure. I mean, it looks to me as though the Fed could do the same again if maybe RBA could do. But there is a question as to how sustainable this whole strategy is, or are we going to actually come to the point at some stage when the balloon is going to touch the floor, and when it does it go pop?
Well, I think it's all about inflation. If we somehow, some way get inflation under control, then yeah, they can go back. They can refill the punch bowl, and the market can go wild all over again. But if inflation remains an issue, particularly in the US and, well, frankly, pretty much everywhere at this point. I mean, you've got the highest levels of inflation in Europe in decades, and that they're probably one of the least well equipped people to deal with that in that regard, with an aging population, and also just incredibly inflation averse people in that regard in places like Germany. I mean, it's kind of insane that Germany has spent the better part of a century trying to be an inflation hawks, trying to jump on it whenever it got serious, no matter the relative cost at the time. And now they've got the highest producer price pressures since the end of the Second World War, which is just insane because their economy had just been bombed into freaking ruins.
Yeah, absolutely. The only place that it's really not showing yet is Japan, right? There the inflation is extremely low. And again, the question is that a timing question or is that a policy settings question? Remember, they've had zero interest rates or worse for quite some time. The government owns even more of the economy than almost any other economy around the world because they've been at QE for a lot longer. So I don't know whether that was also an alternative scenario as to what may happen, or whether Japan will join the party just a bit late.
Well, if they join the party, I think we've all got a rather sizable problem because the Japanese households just they can't take it. They can't. There just isn't the rope there to deal with it. And I think one of the things that's interesting in that regard is that people think that the issue is the government, is the fact that they're in over 200% of GDP in terms of sovereign debt. But it's not going to be the government that struggles immediately. The government can always just borrow more money. Well, not always, but they can keep borrowing money, just like they have for the last 30 years. Yep. The issue is households in the here and now trying to cope with inflation. So while Kuroda, who's the head of the Bank of Japan, may want to keep rates low, I think that in the end, the path of least resistance is actually the Bank of Japan supporting the yen and not the yield curve.
Yep. Well, of course, the yen took a big hit quite recently when they announced that they were going to try and control things a bit longer, and the exchange rate, that movement was significant enough, I think, to perhaps wake a few people up.
Well, you've got former advisors, former ministers now coming out and talking about the need to defend the yen, and I think that is going to be where things eventually go, because I don't think that the Japanese government can't cope with slightly higher rates, because at the end of the day, most of the they've got to pay a little bit more on their debts, even if a lot of their debt is long term, and even if they need to refinance some of the short term debt, it's still going to be at relatively low rates compared with the rest of the world. So I think that they can cope with that for a time, but Japanese households can't cope with rising inflation.
Absolutely. Yeah, well, it is the household sector, unfortunately, that is hit when the inflation forces really come through, as we saw in the 70s, and we'll see again, I suspect.
Yeah, and I think that's true throughout the world.
Yep.
Okay, now this is a nice little chart of the exports of Russian oil via sea, and basically it shows that oil exports since the war in Ukraine began have fallen by around about 1.5 million barrels a day. Now, to put that into perspective, that is roughly 1.5% of overall global consumption. While it may not sound like a lot, when you remove something like that from a system which isn't really equipped to replace it on a relatively, in a relatively swift manner, prices rise, and prices can rise significantly in that regard. Now, the Biden administration has pledged to release 1 million barrels a day from the Strategic Petroleum Reserve, as Martin and I were discussing earlier. But that isn't really enough to fully offset the issues with Russia. And as I mentioned in the little bullet points there below, is Kazakhstan, because they export a large amount of their oil via pipeline into tankers in the Black Sea. Those exports are currently not happening because the Black Sea is considered a war zone by shipping, and so that oil is just backing up. But I'm going to share a bit of a theory here, and if you know more about the oil sector than me, feel free to share your opinion on it. Is that they're going to be able to potentially fill the gap to just enough of a degree in the short term to potentially make this a bearable thing. But the problem is, as Russian oil production slows and as their reserves fill up over the coming months, if the war continues, eventually they're going to have to start cutting production and capping wells. And as Joe Biden came out today and said quite rightly about the US oil industry, restarting oil production is not a quick thing. It is something that even if you've got the resources of the world's preeminent superpower, is still going to take months. Now, for a country like Russia that's been hit by a freight train worth of sanctions, restarting that production is potentially going to be even harder. So, I'm a bit concerned that these reserve releases and everything else could lull the market and the world into a bit of a false sense of security, all while long-term Russian oil production takes a hit that could potentially result in significantly higher prices when the Strategic Petroleum Reserve needs to be filled, and B, when that production just finally ends and the reality of it all becomes clear.
And add into that the fact that China's demand is a little off because of the lockdowns in its major centres at the moment because of COVID. And when that goes away, that's going to put more pressure from a demand side as well. So I think your thesis that oil prices may be higher for longer makes a lot of sense.
Yeah, I think that particular sort of false sense of security thing is quite a significant threat, because, to be completely frank, looking at how the sanctions and the reality of all this has been managed, not just now after the war began, but even pre-war, there was no preparation for any of this whatsoever. It doesn't really bode super well for the future. I mean, I'd like to think that there's that preparation that we're going to be able to get through this, but as I wrote in a piece a few weeks ago, it's not just as simple as ringing up Venezuela and Iran and going, "Hey guys, can you pump some more oil?"
No, indeed, and of course the UK are putting out an energy plan. It was meant to have been 2 weeks ago, and then didn't pass muster with the Treasuries in the UK, so they're still doing it. But for example, if they decide to actually back nuclear as a baseload strategy for the future, you can't just create a nuclear power station in 24 hours, right? It can take 10 to 15 to 20 years. So, there are no short-term easy fixes here.
No, there aren't. Now, speaking of the commodity side of things, well, in recent days, just to put it extremely bluntly, Emmanuel Macron, the French president, and quite a few other world leaders have warned that we're basically heading for a major food crisis, that there's going to be some very, very serious issues, and quite a lot of, hundreds of millions of people are going to face a very challenging time in that regard, particularly if the war in the Ukraine continues for, the foreseeable future. Because, at the moment, rather than Ukraine being the breadbasket of the world, Ukraine is having to receive, foreign aid in the form of food, rather than Ukraine being the one to feed the world. So, that presents a rather major challenge. But, some people point to these, say, for example, the graph on the left. They're like, well, we have 600 million tons worth of grain reserves. We can just burn through some of those reserves over time and we'll be okay. But the problem with that particular viewpoint is, depending on the grain in question, as the chart on the right shows, those reserves are disproportionately held by the Chinese, and they're gonna hold on to those reserves, and quite rightly, looking at it from their perspective, to look after their own people, to keep, in the words of Xi Jinping, to keep the food bowls of the Chinese people filled. So it's not. So I think that the overall picture is really distorted by how much commodities China is hoarding to look after its populace. Because, to be quite frank, they're one of the few people in all of this who seem to have actually prepared for this type of contingency in any way, shape, or form.
Well, it is interesting, and the chart there makes the point that they were starting in 2019 to stockpile, right? So they actually were preparing, and of course, not only are they holding, these sorts of commodities, but they've also stockpiled gold as well. So they've got a lot of resources at their disposal relative to most other countries. Very significant, and frankly, he who holds the resources probably can call the tune.
Well, yeah, exactly, and that's, I think, something that's going to be quite concerning going forward if we do start to see other dislocations in other places. I mean, say for example, there've been riots in Sri Lanka because they've had a currency crisis, and we're starting to see these problems spread around the world. And as we discussed previously, the risk is that snowballs, that impacts other commodities, that impacts other exports and other people, and that then gets well and truly into things that becomes not impossible to predict, but extremely difficult to do with any real level of certainty.
Absolutely. Yeah, and then of course all you want to overlay there is the climate change and the storms and everything else that's going around, and suddenly you find that areas that should be able to grow grain can't because of the climate, and then you've got another intersection of another problem too.
Yeah, exactly. There's just that plethora of issues. I mean, like for example, we've seen Lismore flood twice in a month. I know that there is quite a bit of conjecture over whether this is man-made or whether it's not. But to be completely frank, in the short term, in terms of how this is going to impact the world, it doesn't really matter. It's here. It's causing problems, and we need to be prepared for that. But we're not. And I don't really think any other country besides the Chinese and perhaps a few other smaller ones here and there have really made many strides towards doing that. Although I will say, full credit to French President Emmanuel Macron, he's actually looking at these things and saying we need to increase food production, we need to increase stockpiling, and and as many of you know, it's not often I say something nice about a politician.
Indeed, we should frame that one. And I guess the other point there is that, as with all of this stuff, again, stockpiling isn't something you can suddenly start to do. It takes time to be able to get the resources and then store it, etc., etc. So, this knee-jerk, we have the crisis and then we respond, which is frankly how Australia seems to react quite often, really doesn't cut it. So where is the forward thinking and the forward planning? Where are the scenario engines and engineers in terms of thinking about, well, if this happened, what do we do? I don't see a lot of that here in Australia. No,
and I mean, this brings me back to something that we talked about. I think it was a long while ago now, but we talked about the crisis of the 14th century, of how basically the climate of Europe shifted significantly, and It created issues with famine, issues with inflation, issues with, well, war, and frankly, we're seeing all those things again now. And I think the thing that we're potentially going to see next is as these issues become more serious, as inflation rises, as costs rise for households, I think we're just going to see more and more countries looking after, me and mine, so to speak. They're going to look after themselves. There's going to be export bans. And that's exactly what happened in the 14th century. And neighboring countries went hungry, even when other countries had ended up having bountiful harvests, because it was about keeping prices low, and it was about looking after your own people. And the problem is now is we have a more globalized world than ever, and we're reliant on all manner of foodstuffs and other things from all over the world.
Yeah, and it does beg the question, doesn't it, about our leaders and leadership and how you think about these problems, and to what extent you take an isolationist view, protect your own, versus a more global view. And I see those contentions very strongly at the moment. In some areas still trying to cooperate, like the whole of Europe trying to cooperate in Ukraine, but it's a bit superficial if you peel back and see what's actually going on. But in many other areas, there is a tendency for isolationist policies, and you had another Trump doing that to the US. Boy, it could be quite interesting.
Well, the risk, I think, isn't that it becomes something for that's something that's politically isolated to one party or another. I think that the concern is that as costs rise, particularly because households these days do not have the same slack to deal with things that they did, say, in 1973, 1974 during the first oil crisis. The slack just isn't there. It's not just like, oh, well, we're all saving 20%. We can just cut our household savings and we can cope with this, not relatively easily, but, we can do it. We can tighten our belts a bit. But I think the risk is that protectionism, and not so much protectionism, isolationism, and looking after the country first and foremost goes mainstream. The risk is that someone like Biden, who's, a relative moderate by US standards, starts to turn around and go, well, no, we're not going to export this, and we're not going to export that, because we need to look after our own people first and foremost. And if we do see a long-term interruption to Russian oil production, particularly after the strategic petroleum reserves drawdown is completed, I think things like a US oil export ban, which is well within Biden's purview as president and has been proposed by members of the Senate, are well and truly on the table.
Yeah, I agree. It's again more uncertainty, I fear, unfortunately, but this is the way it is.
Indeed. Okay, this is the last chart for today, and it shows the price of ammonia, which is a part of fertilizer in Western Europe. And as you can see, since the start of 2021, prices have gone up more than 500%. And you don't need to be a rocket scientist to know that Farmgate, the key items in farming going up 500% is going to have an impact on the old food bowl. And I think it's also important to keep in mind that despite the fact that the war in Ukraine and the various Russian bans on exports of fertilizer to unfriendly countries is having a significant impact now, most of the rise in prices occurred prior to the war in Ukraine. And I think that's a key factor in all this, because it's easy to look at the current problems and go, oh, well, that's because of Ukraine. That's because of Ukraine. And yes, a lot of it is. And a lot of these problems have been made significantly worse because of that. But a lot of them were already there prior to the war.
No, good point. And, we were calling out some of these hooks in terms of prices before Ukraine hit. So, I remember some slides from earlier on. And the point there is that sort of move up, right? I mean, that's better than crypto, right? So, folks, maybe invest in fertilizer rather than crypto.
No, I mean, I remember when the first fertilizer plants in Europe shut down. I think it was about July, August last year.
Yep.
And they shut down because of high gas prices. And, we were talking about that particular issue then. And that's when, this particular fertilizer, I think it was around about sort of 450 or 500 bucks a ton. And, now it's almost 3 times that. And it's just, it's crazy to think just how much this is going to impact, in particular, the developing world. And I think as well that a lot of these problems, particularly with the rising cost of diesel globally, a lot of these problems are now already baked into these harvests that we haven't seen that have just been planted, because the farmers need higher prices to pay for those rising costs.
Yeah, that's right. But on the other hand, of course, now everybody's got an excuse. It was the war what did it, right? And so it's amazing. It amazes me how everything is now being seen through that lens, and they want us to forget some of the policy missteps that people took before that, right? And they've got this perfect excuse, the perfect alibi. We'll do the best, but and I reckon that will play pretty well through the election campaign, because both sides of government will probably want to peddle that same barrow.
First point, I think it's the war what did it is probably a good slogan for a T-shirt, so you should probably look into that. But I think we're definitely going to be hearing quite a lot about Vladimir Putin in the upcoming election campaign, and just around the world in general, really, because it's easier just to blame the Russians for everything than it is to take some accountability that their policies helped create this situation in the first place.
Exactly right. Yes, it's always easy to blame somebody else. It was that guy over there, and don't like him, so we'll blame them. But the truth is, a lot of this is self-engineered, a lot of this is self-inflicted, and a lot of these things, the seeds were laid, 2007, 2008, and before, right? So it's worth just having a longer view of history when you think about some of these things. And I'd also argue that the Putin problem was actually created when the wall came down and the negotiations between the West and Russia weren't very well handled, and they didn't actually end up in a sustainable place. So again, there's a long-term story here as well as the immediate.
Oh, absolutely. I mean, things with Russia could have turned out very differently. I mean, I remember reading about a phone call between Vladimir Putin and President Bush after 9/11 occurred, and he said that whatever help you need from the Russian people and the Russian armed forces in order to cope with, in order to help with bringing these people to justice, we will provide. And I think it's sad that we didn't come to some form of agreement that more significantly integrated Russia into the international community, which ironically would have given the West more leverage over improving things within Russia in terms of democratization and everything else. So it's sad that it's come to this. Particularly, obviously, it's sad for everyone, but it's particularly for the Ukrainian people who are now suffering through this war, and we don't know when it's going to be over.
Absolutely. Well, my thoughts are certainly with the people there and the circumstances. But like I say, I think it's important to keep a bit of a longer term context in these things. Some decisions that are taken by leaders around the world have echoes down the years and the centuries. And it's important to understand that actually leadership means not taking just tactical short-term issues and decisions, but also thinking about the strategic positioning and how this can play out. And unfortunately, I fear that at the moment, a lot of the leaders around the world are just being very tactical and very political, and that's not necessarily good for anybody.
No, and I mean, I think we're just seeing the hangover from 2020. You can't spend and print all this money, and especially at a time, at a time when you had the world in lockdown, and then expect it not to create issues. I mean, I'll just a sort of microcosm example, right? Australian households have amassed savings of about $245 billion since the pandemic started. At least that's the latest figure I have my hands on. Now, if they were to spend, say, 2% of that in terms of aggregate demand, that is roughly the same as the RBA hiking interest rates by 0.25%. Now, the problem, obviously, that's very, very rough numbers, so don't quite quote me on that, but it goes to show that something as simple as households spending their savings could completely screw up the RBA's plans to tighten monetary policy and force them to tighten more than they otherwise would have. even though you're going to see this extreme bifurcation between different households, because you're going to have the more wealthy households who hold the money ending up with potentially even getting higher rates on their savings, and then you're going to have people who are highly indebted and mortgaged paying significantly more, and they're going to be the ones who are going to have their aggregate demand hit in order to try and put downward pressure on inflation. So, it's just something so very simple as household savings could really throw a spanner in the works. And the government, by throwing all this money at things, and by throwing all this money by the RBA throwing all this money at the financial system, they've created that scenario now where things could get out of control in that regard.
Absolutely, they've created a monster, and the monster is rampaging. But the war, what did it? I think we'll have to copyright that.
Yeah.
Tarric, I appreciate your time today. Very insightful as always. Thanks for the charts. We'll make sure that the links and things are below so people can go across and look at them at leisure. And we'll do it all again soon, I guess.
Well, there'll definitely be more to talk about, unfortunately. So I'll see you then, mate.
See ya. Cheers. Take care.
You too, mate. Bye.